Most people hear options and immediately think gambling, blown up accounts, Reddit screenshots, lottery tickets. Here's what options actually are: a contract, and when you buy one, your risk is defined. You know your maximum loss before you ever enter the trade. When you buy the right kind of option, your contract has real value built into it from day one. Value that moves with the market and does not decay the same way pure time premium does. This is ground school. By the end of this video, you will understand every number on an options chain and why some options are built to survive while others are built to break. Let's get into it. Every pilot goes through ground school before they touch the controls. They learn the instruments, the gauges, the language. Options have their own language. If you do not learn it, you are flying blind. Here's the flight plan: 6 stops. Each one builds on the last. An option is a contract, not a stock, not a share. A contract between a buyer and a seller that defines a specific right at a specific price by a specific date. When you buy an option, you are buying a right, not an obligation. You can act on it or let it expire. That distinction matters. Options are called derivatives because their value is derived from another asset. In our case, that asset is SPY, the S&P 500 ETF. We are focused on call options. A call gives you the right to buy SPY at a specific price. You profit when SPY goes up. Think of it as calling the shares to you. There is a whole other side of options: selling them, writing covered calls, selling puts. That is its own world with its own risk profile. We are not going there in this video. Knowing how to buy a call option is the foundation for the autopilot your wealth system, and that is what we are covering today. One critical detail before we go further: one option contract controls 100 shares. When your broker shows a price of $40, that is per share. The actual cost is $40 times 100, which is $4,000. Every price you see at a broker is per share, always multiplied by 100. Every option contract has 3 parts: the strike price, which is the fixed price you can buy at; the expiration date, which is the deadline; and the type, call or put. We are using calls. The strike price is the heart of the contract. Let me make this concrete. SPY is at $710. If you buy a call with a $640 strike, that is roughly 10% in the money. Your strike is below where SPY is trading. The difference, $70 per share, is a real value that is already built into your contract. SPY could drop 5% tomorrow and that contract still has real value underneath it. Now look at the other side. A $780 strike is roughly 10% out of the money. Your strike is above SPY. There is zero built-in value. SPY has to rally all the way to $780 before this contract has any real value at all. Everything you paid is time and volatility premium. Right in the middle is at the money. A $710 strike when SPY is at $710. You are right at the edge. This concept is called moneyness. It describes where your strike sits relative to SPY's current price: in the money, at the money, or out of the money. And it determines everything about how your option behaves: how much it costs, how it responds to a crash, and how it participates in a rally. I want you to hold on to this because it is the single most important concept in this video: built-in value versus no built-in value. When the market drops, what happens to a contract that has nothing real underneath it? It can collapse fast. What happens to a contract where it has real value baked in? It takes a hit, but there's something solid holding it up. That distinction is going to matter a lot in the videos that follow this one. The premium is what you pay for the option contract. It has 2 parts, and understanding them is the most important thing you will learn today. Intrinsic value is built-in worth. For a call, it's the difference between SPY's current price and your strike. SPY is at $710, $640 strike. That is $70 of intrinsic value per share. This is the portion of your contract that is real, tangible value tied directly to SPY's price. Extrinsic value is everything else: time remaining, volatility, possibility. It is the portion of the premium that decays as expiration approaches. Every day that passes, some of it evaporates. Now, look at the difference between these 2 LEAPS contracts, both with about 2.5 years until expiration. The $640 call, 10% in the money, costs $16,263 per contract. $70 of that is intrinsic value. The rest is extrinsic. You have a foundation of real value underneath. The $780 call, 10% out of the money, costs $7,101 per contract. It is cheaper, but 100% of what you paid is extrinsic value. There is nothing real underneath. If the market drops, that extrinsic value collapses and there's nothing holding the contract up. Now, most people look at those 2 contracts and think the $7,100 one is the smarter play because it costs less. More leverage, right? Let me show you why that thinking falls apart when you invest real money. Let's say you have $250,000 to put into LEAPS. SPY is at $710. The $640 call costs $16,263. The $780 call costs $7,101. $250,000 buys you 15 of the in-the-money contracts. That same $250,000 buys you 35 of the out-of-money contracts. More than double. That matters. Now, SPY drops 10%, $710 to $639. That's a $71 drop. Each in-the-money contract loses about $4,400. 15 contracts, that is $66,000. You lost 26% of your money. It hurts, but you are still in the game. Each out-of-the-money contract loses less per contract, about $2,800, but you own 35 of them. 35 times $2,800 is $99,000. Therefore, you lost 40% of your money on the same investment. The cheaper contract lost you 50% more money, not because it is riskier per contract, because the same dollars bought you more contracts, and every one of them was made entirely of extrinsic value that collapsed. And here's the part that really matters. After the crash, your in-the-money contracts still have a delta around 50. When SPY bounces back, you are capturing half of every dollar on the way up. Your out-of-the-money contracts, well, those have a delta of around 28. Even when the recovery comes, you are barely participating. You lost more going down and you recover slower coming back up. Now, to be fair, if SPY has a monster year, up 20% or more, those out-of-the-money contracts will outperform because you own more of them and they will accelerate through the strike. That is real. But monster years happen 3 or 4 times a decade. Mild up years, flat years, and corrections happen far more often. And in those years, in-the-money grinds out profits that out-of-the-money cannot touch. In a later video, I'm going to show you what happens across every scenario. Up 20%, up 10%, flat, down 10%, down 20%, with the same dollars invested. The answer is not what most people expect. That is why cheaper is not smarter. When you invest real dollars, in-the-money options lose less in a downturn and recover faster on the other side. One more critical point about the premium. When you buy a call option, the premium is the most you can lose, period. If SPY crashes, if the market falls apart, your maximum loss is what you paid. Your risk is defined from day one. The Greeks is where most people check out. Do not. The Greeks are not complicated math. They are the gauges on your dashboard. A pilot does not sit there thinking about how the vertical speed indicator works internally. They just read it. Climbing, descending, level, that is it. The Greeks are the same way. You do not need to derive them. You just need to know what they're telling you. 4 Greeks: delta, theta, vega, gamma. Delta tells you how much your option moves when SPY moves $1. A call with a 50 delta gains about 50 cents per share. $50 per contract for every dollar SPY goes up. Delta runs from 0 to 1. At 0, which is far out of the money, the option barely moves. At 50, you're capturing about half a SPY's movement. At 70, you're capturing 70 cents of every dollar. At 1, you're deep in the money. The option moves dollar for dollar with SPY. But here's the thing most people miss. Delta is not fixed. It changes as SPY moves, and that is where the real advantage lives. When SPY rises, your delta increases. A 50 delta call becomes a 60, then a 70 delta. You are capturing a bigger and bigger share of the gains. The option accelerates. That acceleration is one of the reasons call options can behave so differently from stock. When SPY falls, the opposite happens. Your delta shrinks. A 50 delta becomes a 40 delta, then a 30 delta. You are losing a shrinking share of the decline. This is called convexity. You participate more on the way up and less on the way down. It is not a guarantee and it is not magic, but it is a structural feature of how call options actually work, and it is one of the reasons I use them. Theta measures time decay. Every day that passes, your option loses a little extrinsic value. Theta tells you how fast. But here is the critical thing. Time decay is not linear. It accelerates. Look at this curve. When you are 2 years from expiration, theta is barely noticeable. The fuel gauge barely moves. At 90 days, you start feeling it. At 45 days, it accelerates hard, and in the final week, it is in free fall. This is why most short-term option traders lose money. They are living in the red zone where time is destroying the position every single day. And remember what we said about extrinsic value? That is the part that decays. If your entire contract is extrinsic value because you bought out of the money, theta is eating everything you own. If most of your contract is intrinsic value, theta is only eating a small piece of it. In the next video, I'm going to show you how long-dated options, leaps, keep us in the flat part of that curve while time decay is almost irrelevant. That is where the structural advantage lives. Vega measures how changes in volatility affect your options price. You have probably seen the VIX on financial news. It is a turbulent forecast for the market. So when the VIX spikes, when traders expect big moves, option prices go up across the board. When it drops, prices come down. Now for our purposes, Vega is less critical day to day than delta and theta, but it explains why your options price can move even when SPY does not. Now let's put it all together. This is an option chain. This is what you see when you pull up SPY options at your broker. The strike column shows your available strikes. The bid is what someone will pay you if you sell. The ask is what you will pay to buy. Delta shows your price sensitivity, how much you participate in SPY's move. Open interest tells you how many contracts are active at that strike. That is liquidity. Look at the $710 row. SPY is at $710, so this is at the money. Delta is roughly $50. Now look at $640, roughly 10% in the money. Delta is roughly $74. More expensive, but most of that cost is intrinsic value tied directly to SPY's price. Now scan to $780, roughly 10% out of the money. Delta is roughly $25. Cheaper, but 100% extrinsic value. And a delta of 25 means you are only capturing a quarter of SPY's movement. See how everything we talked about today shows up right here? Intrinsic value, extrinsic value, delta, moneyness. It is all on the screen. And after this video, you will be able to look at any option chain and understanding what the key numbers are telling you. Last concept. When you own an option, you have two ways to exit. Exercise means actually buying 100 shares at the strike price. That requires the full capital. Sell to close means you're selling your contract to another trader and capturing the difference. The vast majority of options are sold before expiration, not exercised. In my approach, I never hold a contract for more than a year. I sell to close, capture the gain or loss, and buy a fresh one. You do not need to worry about accidentally owning tens of thousands of dollars worth of SPY. Here are the takeaways. When you buy a call option, the premium is the most you can lose. Your risk is defined. Delta tells you how much of SPY's move that you are capturing. Theta tells you how fast your time premium is decaying. And convexity means your participation can increase as SPY rises and decrease as SPY falls. But the most important thing you heard today is this. When you invest real dollars, not hypothetical single contracts, in the money options lose less in a downturn and recover faster on the other side. Cheaper is not smarter. That is the foundation for everything that comes next. In the next video in this series, we are going to talk about leaps, long-term options with 2 or more years until expiration. I'm going to show you why buying time instead of fighting it changes everything about how options work. That theta curve you saw, we are going to use the flat part of that curve to our advantage. This is where the structural advantage lives. If you are brand new to options, do not worry if this didn't click all in the first pass. That is completely normal. Come back to it. Let the concept sink in. Every pilot goes through this in ground school. The point is not to memorize every Greek. The point is to understand what you're looking at so you can make informed decisions instead of guessing. Would you have been able to read that option chain before today? Drop it in the comments. If this made options click for you, hit the like button. And if you want rules-based investing content without the hype, subscribe. Stay disciplined, stay patient, and I'll see you on the next flight.